This is a video of the key takeaways from the book The Intelligent Investor, written by Benjamin Graham. Benjamin Graham was an influential American economist, investor and professor, known as the father of value investing. He pioneered the principles of value investing, emphasizing the importance of buying stocks when they are undervalued and selling them when they become overvalued. Graham authored several seminal books on investing, including Security Analysis and The Intelligent Investor, which remain essential reading for investors. He also taught at Columbia Business School, where he mentored notably investors like Warren Buffett. Graham's timeless wisdom and disciplined approach to investing continue to shape the strategies of investors worldwide. The content of this presentation is Introduction, Value Investing, Margin of Safety, Long-Term Perspective, Diversification, Emotional Discipline, Mr. Market Analogy, and Conclusion. Introduction. In this presentation, we go into the foundational principles of value investing, made popular by the legendary Benjamin Graham. In this journey, we will unravel the essence of value investing, delve into the concept of margin of safety, embrace the significance of a long-term perspective, understand the art of diversification, master emotional discipline, and will also go into the popular Mr. Market analogy. Benjamin Graham's wisdom has stood the test of time, shaping the investment philosophies of countless individuals and institutions around the globe. Through his teachings, we will uncover the keys to prudent investing, disciplined decision-making, and enduring wealth creation. Value investing. Buying undervalued securities. Graham suggests that investors should seek out securities, such as stocks or bonds, that are trading below their intrinsic value. This means looking for companies whose stock prices do not accurately reflect their true worth based on factors such as earnings, assets, and growth potential. By buying undervalued securities, investors can potentially profit when the market corrects its mispricing. Selling overvalued securities. Conversely, Graham advises investors to sell securities when they become overvalued. When the market sentiment drives prices of certain securities to levels that exceed their intrinsic value, it may be a sign that it's time to sell and look in profits. Graham encourages investors to resist the temptation to hold onto overvalued securities, in the hope of further price appreciation, as this can lead to losses when the market eventually corrects itself. Margin of safety. Central to Graham's value investing philosophy is the concept of the margin of safety. This refers to the difference between the intrinsic value of a security and its market price. By buying securities with a significant margin of safety, investors can protect themselves against the inherent uncertainties of the market and minimize the risk of permanent capital loss. The margin of safety provides a cushion against adverse events, such as economic downturns or unaccepted company setbacks. Contrarian approach. Value investing often involves taking a contrarian approach to the market. Instead of following the crowd or chasing the latest trends, value investors look for opportunities in areas that may be out of favor or overlooked by the broader market. This contrarian mindset allows investors to capitalize on mispricings and exploit inefficiencies in the market. Margin of safety. Definition. The margin of safety refers to the difference between the intrinsic value of a security and its market price. In other words, it's the buffer or cushion that exists between what an investor pays for a security and what it's actually worth. Protecting against downside risk. The primary purpose of the margin of safety is to protect investors against downside risk. By purchasing securities at prices significantly below their intrinsic value, investors create a safety net that helps mitigate the potential for loss. Even if the market price of the security declines after purchase, the margin of safety provides a buffer that can absorb such fluctuations without resulting in significant capital loss. Accounting for uncertainty. Graham recognized that investing inherently involves uncertainty and that it's impossible to predict the future with certainty. By investing with a margin of safety, investors acknowledge this uncertainty and build in a margin for error. This allows them to withstand unaccepted adverse events or changes in market conditions without suffering permanent impairment to their capital. Determining intrinsic value. Calculating the intrinsic value of a security is crucial to implementing the margin of safety concept. Graham suggests various methods for estimating intrinsic value, including analyzing a company's financial statements, earnings potential, asset value, and future cash flows. By conducting thorough fundamental analysis, investors can identify opportunities where the market price of a security significantly diverges from its intrinsic value, providing an opportunity to invest with a margin of safety. Long-term perspective. Investing with a margin of safety aligns with Graham's emphasis on taking a long-term perspective, rather than trying to time the market or speculate on short-term price movements. Value investors focus on the underlying value of the assets that they are investing in. By maintaining discipline and patience, investors can realize the full potential of their investments over time, even if the market experiences periods of volatility or uncertainty. Long-term perspective. Rational investing. Graham encourages investors to approach investing with rationality and discipline, rather than being influenced by emotions or short-term market trends. He warns against trying to time the market or engaging in speculative activities, as these strategies often lead to suboptimal results. Instead, Graham advocates for a patient, methodical approach to investing that focuses on the long-term value of assets. Margin of safety and risk management. Investing with a margin of safety, as discussed earlier, is integral to Graham's approach to risk management. By purchasing securities at prices significantly below their intrinsic value, investors create a buffer against market volatility and unforeseen events. This allows them to hold on to investments with confidence, even during periods of market turbulence, knowing that they have a margin of safety to protect against potential losses. Value investing as a long-term strategy. Value investing, as espoused by Graham, is inherently a long-term strategy. It involves identifying undervalued assets, investing in them with a margin of safety, and patiently waiting for the market to recognize their true worth over time. This approach requires discipline and conviction to withstand short-term fluctuations and remain committed to the underlying value of the investments. Compound interest and wealth accumulation. Graham emphasizes the power of compound interest and the benefits of long-term wealth accumulation. By reinvesting dividends and allowing investments to grow over time, investors can harness the compounding effect to significantly increase their wealth. This underscores the importance of maintaining a long-term perspective and resisting the temptation to engage in short-term trading or speculation. Diversification, risk reduction. Graham advises investors to spread their investments across different asset classes, industries, and securities to reduce the impact of any single investment performing poorly. By diversifying, investors can mitigate the specific risks associated with individual securities or sectors. Even if one investment experiences a downturn, the overall impact on their investors' portfolio is less severe because of the presence of other investments that may perform differently under similar circumstances. Asset allocation. Graham suggests that investors allocate their capital across a mix of asset classes, such as stocks, bonds, real estate, and cash equivalents, based on their investment objectives, risk tolerance, and time horizon. Each asset class behaves differently under various market conditions, so having a diversified portfolio can help smooth out volatility and enhance overall portfolio stability. Industry and sector diversification. Within the equity portion of their portfolio, Graham recommends diversifying across different industries and sectors of the economy. This ensures that the portfolio is not overly exposed to the performance of any single sector, thereby reducing the risk of sector-specific downturns or industry disruptions. For example, an investor might hold stocks in technology, healthcare, consumer goods, finance, and other sectors to achieve diversification. Stock selection. Even within the equity portion of the portfolio, Graham advises diversifying holdings to include a mix of large cap, mid cap, and small cap stocks, as well as both growth and value stocks. This diversification across different types of stocks helps reduce idiosyncratic risk associated with individual companies and market segments. Rebalancing. Graham recommends periodically reviewing and rebalancing the portfolio to maintain the desired level of diversification. As market conditions change and the relative performance of different asset classes shifts, rebalancing ensures that the portfolio remains aligned with the investor's investment objectives and risk tolerance. Long-term performance. While diversification may not eliminate all investment risk, it can help investors achieve more consistent and predictable long-term performance by spreading risk across a broader range of investments. By avoiding concentration in any single asset or sector, investors can enhance the stability and resilience of their portfolios over time. Emotional discipline. Avoiding emotional decision-making. Graham warns against allowing emotions such as fear, greed, or panic to drive investment decisions. Emotional reactions to market volatility or short-term fluctuations can lead investors to make impulsive decisions that may not align with their long-term investment objectives. Instead, he advises investors to remain rational, disciplined, and focused on their investment strategy, regardless of market conditions. Staying the course. Graham encourages investors to adapt a patient and steadfast approach to investing. This means staying committed to their investment strategy and resisting the urge to react impulsively to temporary market fluctuations or news events. By maintaining a long-term perspective and avoiding knee-jerk reactions, investors can avoid making costly mistakes and capitalize on the power of compounding over time. Tuning out market noise. Graham advises investors to tune out the noise of the market and focus on the fundamental of the investment they hold. Constantly monitoring daily market movements or reacting to sensationalized news headlines can lead to emotional decision-making and undermine long-term investment success. Instead, Graham advocates for a disciplined approach that prioritizes fundamental analysis and rational decision-making over short-term market sentiment. Sticking to the plan. Having a well-defined investment plan and sticking to it is crucial for maintaining emotional discipline. Graham suggests that investors establish clear investment goals, asset allocation targets, and risk tolerance levels upfront. By adhering to a predetermined investment plan, investors can avoid making impulsive decisions based on short-term market movements and stay focused on their long-term objectives. Countering behavioral biases. Graham recognizes that investors are susceptible to various behavioral biases that can cloud judgment and lead to irrational decision-making. These biases include overconfidence, anchoring, and herd mentality, among others. By being aware of these biases and consciously working to counteract them, investors can improve their emotional discipline and make more rational investment decisions. Learning from mistakes. Graham acknowledges that investing inevitably involves making mistakes. However, he emphasizes the importance of learning from these mistakes and using them as opportunities for growth and improvement. By reflecting on past investments decisions and identifying areas for improvement, investors can become more disciplined and resilient in the face of future challenges. Mr. Market analogy. The concept of Mr. Market. Graham links the stock market to a fictional character named Mr. Market, who is your business partner. Every day, Mr. Market offers to buy or sell his shares of the business at the price he sets. Mr. Market's mood swings between optimism and pessimism, causing him to sometimes offer prices that are irrational and not reflective on the true underlying value of the business. Exploiting Mr. Market's irrationality. Graham advises investors to view Mr. Market's daily offers as opportunities rather than as signals of the market's true value. When Mr. Market is pessimistic and offers low prices, investors can take advantage by buying shares of the business at a discount to their intrinsic value. Conversely, when Mr. Market is optimistic and offers high prices, investors can sell their shares to him, realizing profits. Focusing on intrinsic value. Central to Graham's approach is the notion of intrinsic value, which represents the true worth of a business based on its underlying fundamentals, such as earnings, assets, and growth prospects. Instead of reacting to Mr. Market's daily price fluctuations, investors should focus on determining the intrinsic value of the businesses they own or are considering investing in. By buying when prices are below intrinsic value and selling when prices exceed intrinsic value, investors can profit from Mr. Market's irrationality. Emotional detachment. The Mr. Market analogy also highlights the importance of emotional detachment in investing. Instead of being swayed by Mr. Market's daily mood swings, investors should maintain a rational and disciplined approach to buying and selling securities, based on their intrinsic value. By treating Mr. Market's offers as opportunities to either buy or sell at favorable prices, investors can avoid making emotional decisions driven by market sentiment. Long-term perspective. Graham emphasizes that Mr. Market short-term fluctuations do not necessarily reflect the long-term value of the businesses he represents. Therefore, investors should take a long-term perspective and focus on the underlying fundamentals of the businesses they own. By remaining patient and disciplined, investors can navigate Mr. Market's irrationality and capitalize on opportunities to buy low and sell high over the long term. Conclusion. In conclusion, Benjamin Graham's timeless principles of value investing provide a roadmap for investors seeking long-term success in the dynamic world of financial markets. By focusing on buying undervalued securities, selling overvalued ones, and maintaining a margin of safety, investors can navigate market volatility with confidence and discipline. Graham emphasizes on a contrarian approach. Emotional discipline and a long-term perspective underscores the importance of rational decision-making and patience in achieving sustainable investment returns. Diversification further enhances portfolio stability and resilience, while the Mr. Market analogy serves as a powerful reminder to focus on intrinsic value rather than short-term market fluctuations. Ultimately, by embracing Graham's philosophy and principles, investors can build portfolios that are well positioned to weather market cycles and capitalize on opportunities for long-term wealth accumulation. Thanks for watching, and if you liked the video, please like and subscribe.